Hi, everyone. It's Rick Bensignor, and welcome to this week's In the Know Trader Show. This week, we are going to take a look at several different markets. We're going to start first by looking at the S&P and get a sense of what's going on today. As we record this, the market's off fairly hard to start the day. Check here. S&P down about 15 points or so, some early pressure. So given how much the market's run, we'll take a look at that. Then we've seen that precious metals have been generally moving higher as of recent, and we'll take a look into them and give you some views on what we see there. And then we'll also take a look at the semiconductor space because the names have been on fire as of recent, and often semis are kind of one of the leading parts of technology that the marketplace looks for to get a sense of what's going on. So we'll look at a bunch of names there. So let's start off. We'll flip here to our charts. And let's take a look at the S&P. So this is not the S&P. That's the S&P. Here we go. I'm going to widen out the chart. Okay, so here's a daily look at the S&P since the Christmas bottom. Well, actually, we're looking before that. So we can see all-time highs going back to just near October. And of course, the market's come back a heck of a long way since then. Last week's high was, or maybe it's even, I'm trying to think if it was yesterday, but we've certainly gotten within just about 1.5%, 2% from the all-time high. So to reiterate what I've said before in prior casts, in no way, shape, or form did I think that the December sell-off created a bear market. Since early January, we've been telling you, both here in the podcast and in the No Trader clients who subscribe to my research, and of course my institutional clients, that the low in December was more than just a good trading low. It was actually the low, not just to the S&P, but to all major global equity markets. And we have been riding this bull move for virtually all of it. At one point, we had a quick short on. We lost 1.5%. We're fully back in, but I'm getting somewhat wary up here in the upper 2800s that we could be stalling once again. For those of you who have followed my podcast before and especially paid attention to the in-depth analysis that we did in late January into kind of late February, so 4 podcasts in a row, I deeply went into the Tom DeMark sequential model. That's these numbers that you see on the screen. Both the red 13 count and the blue 9 count coming on top of the numbers often gives a clue that it's kind of deep in the bull trend to first be buying here. And it also gives me some reason to often think that we can get some type of pullback. The cloud model that's also running underneath here, you'll notice that the 13 and 9 that came about a week apart from each other in February went just a bit higher before selling off. We got down to, about 27.20, give or take or so. So we had one close beneath that orange colored line, part of the cloud chart, which is support, rallied again, pulled back in late March. Again, that orange line, which is called the baseline of the cloud model, held a support. And once again, now we're making another 13.9. So I don't want to be adding capital in here. You are seeing some weakness today, as I mentioned. And of course, part of the reason that I show you this model is this is an institutionally used model. The public has very little access to it. It's quite an expensive model to get, and most people are not paying that type of money for it. But in running my business, I do, because it's part of what I do in order to be able to service the clients I do, and take advantage of opportunities that we see in the markets that this, as well as many other models that Tom DeMark developed, I have access to, and therefore the bottom line here is it wouldn't surprise me at all if we still get a pause in the market from here, which means we really don't want to be paying 28.80, 28.90 for the S&P, and I certainly could look for a pullback of 50, at least 50 points. So let's call it in and around 2% to maybe as much as 3% right now off of this move before I'd probably be willing to step in. If I blow this up a bit more, I want you to notice this area kind of right here. So this is both the top of the cloud going forward for the next few weeks. And you'll also notice the maroon colored line at 27.47 and change. That is a propulsion level. That's also kind of, it's part of the suite of models in the DeMark camp. And the fact that these show up very close to each other. So again, the top of the cloud here, let's just say it averages somewhere around 27.55, 27.60, and then the propulsion level just beneath it, 10 points lower. So says to me that that is a very potential downside target, and not so dissimilar to where we saw the market bottom in March. So if we were to get kind of a pullback here, and one that picks up a little steam, that's going to be the first level that I'd really consider coming in to do some more substantial buying. Should that level give way, and depending upon how it gives way, would open up the door for the market to potentially fall all the way down to this pink triangular place here, which is just around 2,600 down to 2,580 or so. So those would be downside targets in a bigger decline now, probably than most would anticipate, but in no way, shape, or form does that put us into a bear market, nor do I think there's any test coming of the December low. Again, in my view, all major global equity indices bottomed in December. We certainly have read quite a bit and could pull back, but I think those that December bottom will not be tested in this phase of any type of market pullback, and unless we went into recession or darn close to it, I just don't see a reason that we get all the way back down to the December lows. In my eyes, December, the sell-off in December was the move that changed way too many people's psychology about the market, got them leaning bearishly, and of course this happens so often. That means that they've missed virtually the entire bulk of this up move because they've kept trying to sell levels thinking that there was resistance. This was probably one of the most significant calls I put out in the last 6 months, in the sense that we never fell into the trap that the December decline was a whole game changer. And looking at, in fact, I can show you here. Let's see. So the weekly chart on the ACWI Oil World Index at a 13 bottom, which again is exhaustion of trend. So this ACWX is an ETF that tracks all the major global markets except the United States. And when I saw that have a weekly sequential signal on the bottom of December, as well as a monthly setup 9 count on the bottom into the cloud as support, that was my call, that this would be all the market would decline to, and that it would be up from there. So in fact, if you look at where the ACWI index is now, ex-US, you'll see it is up against some resistance because from the cloud model, you see this orange line, at least, is somewhat potentially capping the move here. So certainly we could pause in here. But again, this 9 count here says to me that was the bottom to the whole thing. So going back to the S&P, here's the daily chart. Here's the weekly chart. The weekly chart still has targets slightly higher. We're getting closer to exhaustion level here at 29.11. The market did peak essentially against its this 29.37 or 29.38 level that it peaked again at on its all-time highs. Was for those of you again who understand some of the DeMark modeling, this 13 that came right in here said that if we get above this level, then the 13 was wrong in anticipating a top to a move. It actually went right to it before we sold off for October, November, December. So certainly a very effective model in being able to help call places within trends that you don't want to be playing in the direction of the trend. So again, my near-term call on the S&P is we probably pause in here and pull back. No reason to be paying anything in the upper 2800s to get long exposure in the market. And I suspect that anybody who is basically doing so because they need to be, not because they want to be. So that means, you've got shorts who have been squeezed. You've got portfolio managers who missed so much of this move and kind of plowed into stocks late into this rally, especially around the end of the first quarter. So we saw a rally in the end of March into early April. And when I see these signals showing up here as far as a timing perspective with the sequential 13 instead of 9 count, it says to me, certainly a pause is in order and no reason to be chasing here. The other thing I'll mention is something I've told my institutional clients, which is that for the first time this year, and I said this a week ago in our Sunday night report, so a week ago Sunday night, is that since January, we've been saying the market, the pain trade is to the upside. And the pain trade could be defined as which way the market needs to go to hurt the most amount of people. And in this case, I had no doubt that a market rally would hurt far more people than it would help because of the December decline and how many people / portfolio managers were underinvested and or allocated into the wrong sectors of the market. In other words, being much more on the defensive side instead of the cyclical side. And it's been the defensive side that has trailed badly this year because the need to be in staples and healthcare and we'll say telecom and utilities is not nearly as much as it needed to be in fourth quarter. So as portfolio managers came into this year, they were mostly defensively postured, and now they're chasing after performance. So I could see, again, a possible decline come. It's not going to be a game changer. But for the first time this year, let me go back to what I said a week ago Sunday, is that for the first time this year, I could make the case that a 100-point decline in the S&P right from here and now would be just as painful as another 100-point rally for the street. And therefore, I think the market's more in balance right now because of how much benchmark chasing has been done and people who got into the game kind of in the latter stages of the current rally. Doesn't mean the current rally can't keep going. But I think now if we sold off 100 or 150 points, it would hurt these people who came in very late to the game, especially around the changes of the quarter. Okie doke, let's move to the gold market. Okay, so here's gold on a weekly chart. And we actually are positive gold. Now take a look back historically. So I'm going to add a little more data here. Go back several years. And it's easy to see what a wall of resistance has been in gold north of 1350. And notice how many times those peaks came at the same time the timing model suggested exhaustion of uptrend. So gold clearly still has a massive wall between 1350 and 1375 to get through in order to really get more buyers coming in. At the same time, it's Doesn't appear on this chart, but actually I could, here, if we just add a simple trend line from, oh, actually, if I remember, I think it's yeah, let's take a look. I think it was 2008 low. So if we go from the 2008 low to the 2015 bottom made after all-time highs, which were north of 1900, you can see back in 2011. The decline in 2018 actually came right to the trend line. You had one weekly close just beneath, and we've bounced since there. Now, if I put this back into a little more easy to see scaling, you'll see recently the 1275, here, let me circle this. Look at all of the weekly lows in 2019 from 1275 to, let's say, 1280, 1285. And it did so again last week. So from an investing point of view, we think anywhere from 1295 down to 1240 is the place that you want to get long gold as an investment. Because I do think with growing global debt the way it is, that it's only a matter of time before the S&P breaks through all these prior highs, crosses over 1,400, and gets back into the $1,400 to $1,600 range. So I am actually bullish gold. Tactically, I'm kind of bullish gold too, shorter term, just thinking that with all these lows here in 2019 where they've been, gold still is something I want to own. And as I said, in general, metals are doing decently. Gold's up somewhat this year, but minimally in dollar terms. But you know, let's take a look at, let me flip this and take a look at platinum. You can see that platinum's had a much stronger move. Look at the beginning of the year where platinum was trading much closer to $825, and now, of course, it's trading about $900. This is something that we got in the No Trader clients long, probably, and I think it's probably close to 2 months already. So the bulk of this year we've been long. We've captured this really well, and getting close to probably taking a little off the table, just based on the weekly count on a 12, the daily, if I'm not mistaken. Yep. Yesterday we saw a 13 for a potential near-term high. So somewhere up north of 900, I may take some off the table because we're long at 830 or something equivalent to that. And for a commodity, that's a heck of a good move. But longer term, let's go back. So here's, let's just draw this trend line. Going back from 2016, and you can see we've just popped through that last week, but let's look at a bigger picture. And I kind of like, here, let's go back all the way to 2004. If I draw this line straight across the bottom of the chart, the 2004 low captures the 2008 low, captures the 2018 low. We could adjust trend lines from all-time high and say that $1,000 could now be a very likely upside target. And eventually, I think platinum also will make its way through $1,000. But now that it's hurdled 900, and you're looking at its showing price of 901, that's the April contract, but that's not the current liquid contract. That would be July platinum. So it's actually trading July platinum somewhere around 908 as we talk right now. I kind of like the way this looks. So I like the precious metals in general. Let's take a look also. This is not something I suggest you trade whatsoever, but palladium has ripped to the upside. Palladium is also a precious metal. It is, in fact, now, based on its price, the most precious metal. So when we talk about precious metals, generally we're talking about gold, silver, platinum, and palladium. Platinum and palladium are called the white metals. And this is something that, again, suggested to me upside exhaustion of trend. I actually traded for a fund and shorted palladium up at 1521 and bought platinum against it. And that's been a heck of a good trade because I made about $200 on the short side of palladium and about $70 to $80 on the long side. So both sides of this pair trade have worked. I do not recommend you trade palladium. It is a super, super thin market. Typically, in the futures market, it's one lot bid offered with a one lot offer. And even as I look now, it's about $1 spread in between. So the reason I'm showing it to you is that this is part of the precious metals complex. Platinum and palladium often end up being used for catalytic converters, and depending upon the price of them, car companies will switch which one they purchase, and there's it's not an instant decision. You can't just change from using platinum to palladium. Things have to get retooled, and it's not a simple process, but given how much palladium skyrocketed, the cost to use it up here makes it much less in demand and puts platinum back in demand. So I kind of like the platinum from that perspective too, is that it should get a bid for its actual industrial use, besides the fact that it's a precious metal and looked at in some way as a hedge against, economic failure, not the same way as gold, obviously, but that's that. So the other thing I want to do too, while we have a few minutes left, is to shift and take a look at the semiconductor space. So let's start off. Let's see. Let's just look at, here's the Philadelphia Semiconductor Index, the SOX index, and this is kind of the most known of indices to look at in the space. And what we've done is, so we've just made new all-time highs this week, or I take it back, last week, and we're pulling back a little. So notice here too, do I really want to be chasing here and now? Most technicians would say it's a technical breakout. It's, it took out all the highs and we broke through. From this index's point of view, anywhere from current price up to 1513 is really potential, still resistance. So I may let this pull back underneath where a lot of people would start buying now, which is against the old highs. If I cut this out to a daily, let's see if we can give a better sense of where this becomes more interesting to me. And then we'll look at a couple names within the space. So the places to look at, if you think just about the entire index in SOX terms, I'm more interested down almost 100 points lower than where it's traded, somewhere either against this line or here, which so that makes it roughly 1396 to 1388 as a place to bid, and do some bidding in there, and then some if it comes against the cloud. That's what I think, because it is, again, a little ahead of itself as a group, and I'm a little suspect of this supposed weekly breakout. Even if I look at the weekly cloud chart here, I've got these 2 points there. These are unrelated models still coming something in the mid 1380s as the place that the support is. So that's 80 points lower or so than where we're currently trading. Let's look at some of the key names in the space and see if their charts look similar. You can see that Intel, which is what this chart is on a weekly 9 count this week. That's a set of nine consecutive weeks that the closing price is greater than the close from 4 bars prior. That's often a short-term turning point. So again, I'd wait for a pullback, probably 52.5, 52, rather than the 55-ish it's trading now, if I was looking to get long Intel. Notice back in December, a weekly 13 count helped call the bottom. So if I'm going to be a buyer, I'm not going to chase right here. Wait for it to pull in. Let's look at NVIDIA. It's been on a tear also. So look, like most stocks, this has been on a tear since December, but notice that it is still way off its highs. I'm facing some potential cloud resistance this week against this orange line, which is called the baseline. It's the midpoint of the last 26 price bars in this case, because we're looking at a weekly chart. It's 26 weeks. And it wouldn't surprise me if it pulls back down to this level, which is the midpoint of the last 9 weeks. So that's 160, what is that, 169-ish. No, yes, 166-ish. So again, I don't want to chase right here. I think you probably can get a better price. Let's look at Micron. So this is a name, and I'll pull cloud off here just because for right now what I want, it's kind of in my way. So back in 2018, I rarely publish recommendations on individual stocks. For my institutional clients, we look at global macro, and we'll talk about individual stocks, but each portfolio manager has their own needs, so I don't generally publish about individual stocks. I publish about indices, foreign exchange markets, the bond market, etc. And in the No Trader, we only trade ETFs. We don't trade individual stocks, so that as individual investors, you don't get the single stock risk that you have in trading a single stock. Of course, it potentially could limit the upside, but I'm more concerned about limiting the downside. So I like trading ETFs for individual investors. So I want to thank you for joining us this week. As always, the half hour seems to go by very quickly. If you need to reach me, it's Rick at In the No Trader, and check out inthenotrader.com for our individual investor report. Thanks very much. Have a good week.